Hi, my name is Paddy Hirsch. I'm a senior editor at Marketplace, and today I want to talk about cramdowns. Now, if you haven't heard of a cramdown before, you probably soon will, because it's one of the ideas that's been posited as a solution to our foreclosure crisis. Large amount of foreclosures in this country right now, people defaulting on their home loans, to the tune of $250,000 in the last quarter. It's a big problem, and a lot of people have been saying that a cramdown could be cramdowns could be a solution. So what exactly is a cramdown? Well, here we are. Get it up on the board here, and the title says a lot. It's when you two words, cram and down. It's when you take something and you cram it down. And what they're talking about is they're talking about the principal on a loan when they talk about the cram down. So how would that work? Well, let's take our mortgage holder. Here he is. His name's Fred. Okay, now Fred used to be a very happy chap when he bought his house at the height of the market. Here it is, height of the market, and he bought it for $1 million. Okay, so that's what he bought it at. Now, for whatever reason, Fred is now not able to keep paying the interest rate, or to keep paying the interest on this mortgage. Perhaps he got one of these dodgy 228 mortgages, 2% for the first 2 years, then 8% thereafter. Perhaps he lost his job, or perhaps there's less income coming into the family, whatever it may be, but he is not able to pay the 8% that he is now due to pay on his 30-year mortgage. Okay, so that's his interest rate. That's the maturity of the loan, but he can't pay that 8% anymore. So what happens? Well, he starts to go into negotiations with the bank. Maybe he forecloses. Maybe he goes into bankruptcy. Now, cramdown is a bankruptcy term. So say this goes to bankruptcy, and we get a bankruptcy judge involved. Here she is. Here's our bankruptcy judge. Not sure what her name is. Not Judy, certainly, but she's not a happy woman. Okay? And neither is Fred. Okay, because he's about to lose his home. So when the judge decides to administer a cramdown, I want you to think of a cramdown like a piece of cake. So here's this piece of cake here. Now, the reason it's a piece of cake is because it's a good thing. It tastes great to some people, but it's also a bad thing in many ways. So I'll tell you how this is. So what's good for Fred? Well, what the judge does is she says, we're going to reevaluate the value of this home. Say the market has fallen in this house, for this house, as it has quite a lot right now. And this is a situation we're seeing now where the markets have dropped out in many parts of the country, sometimes as much as 60%. But in this case, let's say that the market has fallen 25%. So this house is now worth $750,000. All right? What the judge says is we're going to take this as the new secured loan. In the original loan, this $1 million loan that Fred took out first with the bank, the whole $1 million was secured, and it was secured by the value of the house. But now this house is only worth $750,000. The judge says, well, this is the new secured amount, $750,000. So this is the secured loan. It means that the second part to this deal, of course, which is a $250,000 unsecured loan. Okay, but essentially what this means is that the secured loan, that $750,000, is the loan that Fred is really going to owe. Okay? So what does it do if you cut down the size of the loan that Fred has? Well, it does a number of things. Firstly, if Fred, by some miracle, is able to keep paying his 8%, it means that he would be able to pay this loan off much more quickly. So the first option, if this happens, is a quicker paydown. Okay? What happens more often, however, is that the $750,000 is now amortized across 30 years. Okay? So he's now got 30 years. Instead of having 30 years to pay $1 million, he's got 30 years to pay $750,000. What's that going to do? It's going to reduce this interest rate. So that's the second point, is that it reduces interest rates. Okay. So why is this a good piece of cake for Fred? Well, it's great because the first thing that it does is it can reduce his interest rates, and it can keep him in his home. It's a great thing for Fred. Why is it not such a good thing? Well, some people would say that it might it induces this whole issue of moral hazard, and it might make him a little bit less aware of what risks he should and shouldn't be taking. But what about for the banks? Well, again, it's like a piece of cake for the banks. It's a great thing for the banks because it keeps Fred in his home. And the one thing a bank, well, in many cases, and certainly in this market, what a bank doesn't want to do is to be holding a house in a market that's falling really quickly, because it means that the bank has to then go out and sell the house in order to realize to get its money back. So it's much better for the bank to keep Fred in the house and to keep him paying an interest rate, even if it's a lower interest rate. So that's the good side of that slice of cake. All right. The other reason why it's a piece of cake for the bank, not such a good thing, and this is another reason why bankers call a cramdown, and that's the slang that they use, is because it's rather like our bankruptcy judge going to our poor banker, don't feel too sorry for him, and taking this piece of cake and basically cramming it down his neck. Because the cram down is what the judge is forcing the bank to take. It's an arrangement that the judge is forcing on the bank. It's taking that piece of cake, it's taking that gift that it's given to Fred, and sort of a quasi-gift that it's given to the banks, and it's forcing the bank to take it. It is being crammed down the bank's neck. But what's the alternative for the bank? Well, as I said, if the bank kicks Fred out of his home, if he forces Fred to stick to the original arrangement, it means that Fred is going to be on the street. The bank is going to be owning a house in a market where prices are falling. It's going to have to sell probably at an even greater discount than the $750,000 that the judge has valued the place at. And that's going to leave both the bank and Fred and all of us, frankly, very badly, needing a drink.